Okay, I am live here with Pierre-Paul, and this is myself and Pierre-Paul's first time meeting, but he's been on the podcast a bunch of times with Tom and Nick, and he's a really interesting guy. Pierre-Paul, I didn't tell you before, but I've listened to all your podcasts. You seem like a wealth of information when it comes to multifamily and multi-unit, specifically in Canada, and we've been getting a ton of questions recently about multi-unit and multifamily investing, so I wanted to bring you on, ask you all about what you're seeing, not only in Alberta, where you're investing and you're living out there and skiing a lot in Lake Louise, it seems, but also across Canada, what you think about Ontario, multi-unit financing in general, just get a kind of overall update on the multifamily market. So just for anyone who hasn't heard you before, can you give us a really quick intro of who you are, your background, and what you do?
Yeah, first, absolutely, Anthony. So thank you for you guys, for Rockstar, to have me on once again. But I always start these speaking engagements, whether virtual or in person, with a little gratitude rock that I picked up from the shores of Lake Titicaca. You probably know this, Anthony, if you've been following me. So I appreciate having this kind of a platform to share my knowledge. So yeah, my background is quite unique in terms of the multifamily world. I started working for CMHC International at the head office back in 1996. At the time I got engaged, got married in 1997. And so again, I repeat, it was for CMHC International. Basically, the World Bank, believe it or not, and its subsidiary, the International Finance Corporation, the IFC, approached CMHC, Canada Mortgage and Housing Corporation, my employer at the time until 2010, to assist foreign countries in setting up mortgage default insurance. You've got a question later on that we can address, but CMHC basically does not provide financing. It used to do that when it was after the Second World War, because it was created in order to house veterans returning from the Second World War. Back then, it was directly providing financing to investors or borrowers. Now it doesn't do that anymore, but what it does, it insures loans that banks provide to guys like you, like me, and you, in terms of investors when we buy real estate, in this case, multifamily properties, apartment buildings. And the banks provide the financing. CMHC comes behind and insures the loans against default by us investors / borrowers. But so basically, the World Bank came in. I worked on international housing finance in amazing places: Africa, Europe, Romania, China. What did I mention? Oh, the Middle East, West Bank, and Gaza. Believe it or not, I helped create PMHC, Palestine Mortgage and Housing Corporation. Shook hands with the Yasser Arafat. I don't have the picture with me, Anthony. I'll send you a picture of that. But yeah, I did some cool shit with CMHC in my international career as a project manager. And I wanted to deliver on the actual core expertise of CMHC, which is, like I just said, mortgage default insurance. So in 2002, I got an assignment out here in Calgary, in the Prairie region. I started as a single home underwriter, again, providing, insuring homes against defaults by the borrowers. So insuring principal residences, what you hear in the media all the time, and small rental properties, which are categorized as 1 to 4 units. And then I started managing. I was offered a job within CMHC in the regional office in Calgary as the manager of default management and real estate, which is quite important in terms of my background. Real estate side is when CMHC, somebody, a homeowner defaults on their homes, or an investor, 1 to 4 units. The bank tries to sell the asset back, put it back on the market to sell it. After a certain time of exposure, if the bank is unsuccessful to sell the asset back after the borrower defaulted, then my department would take these assets back, these homes back, and I had a small team that I was managing that would try to sell these homes, obviously at a discounted price. So that's why a lot of people sometimes say, hey, can I have CMHC's list of homes that are discounted because they've been exposed on the market? Although these days there's not a lot of defaults, or there are defaults, as you know, they get snatched up pretty quickly. Lenders don't have a hard time selling the homes. So that's what I did. So that's one component. That's the real estate component of my job. The other one is default management. Is a default management of what? Of apartment buildings, Anthony. And here's the key thing that I want people really to remember to this day. Apartment buildings, multifamily properties of 5 or more units, to this day, Anthony, rarely default. And they're not about to default. It's a very low risk asset class. Basically, if you think about it, the last check to bounce is your rent check. You need a place to live, okay? And we saw that. I've been through how many recessions now? Well, we saw that during COVID. We saw that during 2008. We saw that during 2009. We saw that during 2010. We saw that during 2011. We saw that during 2012. We saw that during 2013. We saw that during 2014. We saw that during 2015. We saw that during 2016. We saw that during 2017. We saw that during 2018. We saw that during 2019. We saw that during 2020. We saw that during 2021. We saw that during 2022. We saw that during 2023. We saw that during 2024. We saw that during 2025. We saw that during 2026. We saw that during 2027. We saw that during 2028. We saw that during 2029. We saw that during 2030. We saw that during 2031. We saw that during 2032. We saw that during 2033. We saw that during 2034. We saw that during 2035. We saw that during 2036. We saw that during 2037. We saw that during 2038. We saw that during 2039. We saw that during 2040. We saw that during 2041. We saw that during 2042. We sa We're going to see that again this year. It looks like we're in the beginning of a recession. I saw that in 2008, 2009 during the Great Recession. So I was so bored out of my mind because I had no defaults to manage. I said, hey, I'm bored. Can I move to the front end of the business, which is as a multifamily underwriter and basically underwriting apartment buildings. So that's sort of my very unique background, very, I would say, thorough. I have copycats that teach multifamily investing, oftentimes, majority of times, graduate students of mine who came through my workshop, but there's only one Pierre-Paul. So as Donche used to say, often imitated but never duplicated. So in terms of the breadth of knowledge that I have, which is kind of cool to be able to teach that for that kind of and when I teach, Anthony, you're going to laugh, but because of this breadth of knowledge, now I like, I'm a teacher, right? I wear different hats. If I'm speaking from an investor's perspective, since I used to be a lawyer and I can take dirty jokes about lawyers, I'll wear this hat. And of course, I got one more hat.
So Pierre-Paul is showing different hats with one was an investor, one is a legal one, and one is a CMHC hat. So you wear many hats.
I do. And I want students to know what I'm expressing an opinion as an investor, then and wear the appropriate hat, and vice versa if I'm expressing an opinion as a former underwriter, if you will. Yeah, because nothing is black and white in this business. I'm sure you've noticed that, Tony.
Yeah, and depending on where you're speaking from, your perspective will change. So that's a good little visual cue you have there.
Absolutely.
So when you say you moved to the front end where you started underwriting apartment buildings, so that was the insurance for those apartment buildings?
Correct. What I just described earlier, CMHC, the banks provide you with the money, the financing, but CMHC comes behind and insured the loan against defaults by the investors or the borrowers, if you will. So that's mortgage default insurance. That is essentially what CMHC does. Yeah.
Okay, so for like single family residential, any down payment less than 20% down is going to need mortgage insurance in Canada, depending on the amount, different, amount of insurance. So how does it work in the multifamily space?
Same idea. The underwriting parameters are very different. And as a matter of fact, they changed significantly just a year ago this month in March. But it's the same idea. CMHC comes behind and insures the loans against defaults by the borrowers. It's a much different world. It's more business-like world, Anthony, in the sense that, well, first of all, you need to qualify for mortgage financing when you move to the bigger leagues, if you will, of real estate investing in multifamily properties. The general qualifying factor is that your personal net worth is at least 25% of the loan amount. Now, not to be confused with 25% down payment. So let me backtrack and repeat this in a different way. If you want to qualify for financing, your personal net worth should be at least 25% of the loan amount that you're asking for. And by the way, sometimes lenders, if you don't take Pierre-Paul's course, lenders can lie to you, say, oh, you need 50%. For CMHC, it is 25% of the loan amount in personal net worth in order to qualify. So that's one thing. But at the end of the day, Tony, everything I'm going to be telling you and sharing with you in this interview, I've got to put a big caveat. At the end of the day, whether it's CMHC or any bank, they have the final word. There's actually guidelines that are published, for example, for CMHC, right? These guidelines here, underwriting guidelines, which I highly recommend people, maybe I'll send you a link so people can download this. But that's what I just said, what I just stated, 25% of the loan amount to qualify. It says that right in here. But at the end of the day, when the underwriter, whether it's CMHC or a conventional lender, which is the other way that we can finance deals, at the end of the day, every deal is analyzed on its own merits, case by case. Despite, let's say, for example, with CMHC, it says 25% of the loan amount to qualify for financing. If the underwriter analyzing your deal feels that the risk is greater, maybe you don't have experience in managing apartment buildings, they can require 50% of the loan amount in personal net worth. So at any moment, what I want your listeners to understand is that these guidelines can change at will based on the bank's or CMHC's discretion. So nothing I say is cast in stone. Every deal is analyzed on a case-by-case basis. What else is different? So let's start at the top. There's two ways of financing your deals when it comes to apartment buildings. There's conventional financing, which is never CMHC-insured, and then there's CMHC-insured financing. Conventional financing, there are some limitations, but there are some flexibilities. Let me run them by you. In terms of limitations, the maximum loan to value when you go conventional financing, and again, conventional financing is not CMHC insured loan, okay? Non-CMHC insured loan. Maximum loan to value, 75% loan to value. So that means that bare minimum, you're going to put 25% down. That's a down payment, okay? Maximum amortization is 25 years, okay? However, conventional lenders are more like you and I, business owners. I'm assuming you're a real estate investor, you work for Rockstar, so you know what I'm talking about. Conventional lenders are more business-like. They will understand our business realities and accordingly be more flexible in that regard. And they will understand our business realities. Okay, so that's the conventional side. Whereas CMHC, and this is new from a year ago exactly, CMHC came out with a brand new product, which is called CMHC MLI Select. I know how well that, can you see this clearly on your screen?
Yes, you're saying MLI Select, like the letters MLI.
Correct.
Okay.
And again, Anthony, I'll share the links with you. People can find that or I'll send it to you. I think that was a presentation that I downloaded. So let me run it until a year ago, until this program came out. Okay. Up until then, in terms of loan to value, the maximum LTV was actually 85%. Okay. Maximum amortization was 40 years. Minimum debt coverage ratio, and I don't want to scare people, this is a very easy ratio. NOI, annual NOI, net operating income, we'll come back to that in a moment because I think one of the questions is how is it calculated? Your net operating income, which is not your net cash flow, it's just the income obtained from operating the asset, divided by your annual mortgage payment. Okay, that's all. And then you get a ratio. So that's simple. Okay, it's not very complicated. But the minimum DCR for CMHC until MLI Select came out last year was 1.3. Okay, so I've talked about that. So, okay. Now, since MLI Select came out, why did MLI Select come out? Why did CMHC come out with a product like this? This product now allows you the loan to value, the maximum loan to value, instead of being 85% is now, listen to this, 95% of the loan amount, or the lending value, I should say. Okay, so we went from before MLI Select last year to at 85% maximum loan to value, now to 95. So think about that, Anthony. That means you can, technically speaking, put 5% down. Okay.
So Pierre-Paul, this is just to be clear, CMHC insured mortgages have access to this lending program. Correct.
It is CMHC insured financing only. Conventional lenders do not provide mortgage default insurance.
Pierre-Paul, are there other mortgage insurers in Canada? Like I know for single family, there's Genworth.
For multifamily that I know, no, I don't think there are. No.
Okay.
So I'm not 100% sure. I'm always so stuck in my CMHC world. I don't believe so. Yeah. For multifamily. Yeah, you're right. For smaller rental properties, there are more other mortgage insurers.
No, it seems like for single family, it seems like CMHC is still like the largest one of all of them, right?
Yeah.
They insure the most?
Yeah, no, absolutely. Yeah, they are. Yeah. Okay. So this is a big change. So one thing with MLI Select, you can now go up to 95% of the loan to the value. The minimum debt coverage ratio is 1.1 from 1.3. And the maximum amortization, Anthony, is 50 years. So these are huge new flexibilities in the last year. It's actually earth-shattering is the way I would put this. Wow. Why did this come about?
Yes.
I follow, obviously, my good friends Tom and Nick like a religion. Love Tom and Nick and the whole Rockstar family very much. I wish I were in Toronto to attend all the events. But anyway, if people are not aware of this, and let me get close to the camera, we have a freaking severe housing crisis in this country. And brace yourselves, you folks out there, because it's about to get bad. It's really bad. The housing shortage is insane. It will take decades to solve, okay? And it ain't about to get solved. That's why I tell people, get in the game with multifamily or any kind of rental property that you can get, because it's going to become, and it's starting to, a social issue. I was just listening to the French news in Montreal. Montreal, there's 24,000 homes or families that are looking for a place to live, just as an example. And this is across Canada, right? And we know the federal government. So CMHC said, okay, we need to address this housing crisis. It's actually, and I want to quote Benjamin Toll, which I'm sure you know, CIBC economist at CIBC World Markets. He actually calls it a housing emergency. The word crisis is too weak. It is an emergency, like a real national emergency, not like the protesters in Ottawa last year. Anyway, sorry, had to throw that one in. Your listeners will know me enough to know better. So CMHC came out with this program to alleviate this housing crisis, and they're trying to achieve three social outcomes. One is affordability. The second one is energy efficiency. And the third one is accessibility for people with handicap. So creating more affordable housing, more energy efficient, and more accessible for people with handicaps. And that's why they're providing these kind of extraordinary advantages, which conventional lenders do not provide. So it is earth-shattering. I'm actually submitting my first CMHC MLI Select myself. And of course, I cover that in my course when I teach this stuff. So at a glance, that's sort of the differences. So just to recap again, I'm a teacher. I'm sorry, I know I got to recap and summarize. CMHC, the two ways to finance your deals on the multifamily side: conventional financing, which is not insured by CMHC, and maximum LTV, loan to value 75%. Maximum amortization is 25 years, okay? And minimum debt coverage ratio is 1.25, okay? It's not a percentage, it's a ratio. So, and now you got CMHC, which all these flexibilities that I just mentioned, up to 50 years amortization if you use this program. In exchange for this program, I should expand a little bit more on that. You get allocated a number of points. I don't want to get too detailed, Anthony, because it can get, well, it's not that complicated, but the more units you have affordable, if you keep them affordable, basically that the rent for a medium income renter, if you keep it below 30% of their income, you get X number of points, up to 100 points, and you get to benefit the maximum benefit that MLI Select. So I think for the purpose of this call, without getting too technical, is just to alert people that this is new from last year. And I mean, imagine a lot of something that would have stopped in the past people from investing in apartment building would say, well, I don't have enough, I don't have 25% the loan amount, right, in down payment, or, you know. So now you have greater flexibilities. But I warn people as well. Yeah, go ahead.
So with this MLI program, you mentioned that the purpose of it was to increase the energy efficiencies, the accessible housing, and affordability, right? Yeah. So now this MLI program, I guess we could sum it up by you basically have to hit upon these three aspects, and you earn points for hitting on these three aspects, which then offers you the premium financing option that you have here.
Exactly.
Okay.
And lower premium. Should I say that? Because it's an insurance, just like a car or a health insurance. You pay a premium, but the more you hit these points, the more points you get, the cheaper the insurance premium gets as well.
Okay.
Which you don't pay a premium when you go conventional financing because your loan is not insured, right? There's no insurance to cover your loan. Yeah, you're correct. You're on the money.
Okay.
Yeah.
So you teach these multifamily courses, as you've kind of alluded to. What do you teach most of your students to kind of go with? Is it the conventional financing for multifamily, or is it the CMHC mortgage insured financing?
All of it.
All of it, depending on the situation of the person.
So it's a very good question, very good nuance. Actually, all of it, because you may use all of it. Okay. I think one of the questions that you had pre-submitted was, which one do you use most? Because of these flexibilities that I mentioned, like let's say, for example, longer. If you go CMHC, you can amortize up to now 50 years if you go CMHC MLI Select. Imagine what it does to your cash flow if that's what you want to do, right? Your loan is amortized over a longer period of time. Mind you, it's going to take you forever to pay the loan down, but maybe as an investor, that's what you want. But I teach both because as an investor, I need both types of financing. For example, as I mentioned, conventional financing is more business-like. And if I buy an asset, it needs a lot of TLC. I need to turn the property over. I need to complete some significant improvements. I need to maybe clear some tenants. I mean, there's some issues that needs to be resolved, or maybe I need time to increase my rent, depending on your jurisdiction. I know in Ontario it's quite restrictive, rent increases and so on. So I need more time to stabilize the asset and maximize the performance of the asset, namely maximizing income wherever I can, and reducing operating expenses in order to maximize what? My best friend, NOI. When you're a multifamily and apartment building owner, the net operating income is always your best friend, because for every dollar in increased net operating income, depending on how compressed cap rates are in your market area, the property will appreciate exponentially, like a ratio of 1 to 15 or 1 to 26, let's say downtown core Toronto. If you were to buy an apartment building, the more the cap rates are compressed. So you can create equity a lot faster. It's one of the greatest advantages of investing in larger apartment buildings.
Wait, sorry, Pierre-Paul, can I stop you?
Yeah,
I didn't
absolutely.
I didn't fully understand that. So by increasing the NOI, which is like essentially what, your cash flow from the property?
No, big mistake. Thank you for asking the question.
Okay.
It's the income before you service your debt. So it's the income generated from operating. So it's all my income, all my rental income, and plus my ancillary income. I have a building that I rent parking stalls to the nickel building next door. So that's recurring income. Minus my vacancies, I get my effective gross income. From my income, I have to subtract all my operating expenses, insurance, property management, advertising, utilities, and all that. And then, so my effective gross income minus my operating expenses gives me an NOI. But so net operating income. Then I have to subtract from my NOI my mortgage payments. All the numbers are annually. Then I end up with my net cash flow. So NOI is before you subtract your mortgage payments on an annual basis.
Okay. Thank you for breaking that down. Now, how does the NOI impact the appreciation? You mentioned that it has a massive impact on appreciation.
Yeah. So for a lot of your listeners, they invest in smaller rental properties, 1 to 4 units. The way of arriving at a value of a small rental property, when I say small rental, 1 to 4 units, okay, anything up to 4-plex. The way to arrive at the value is by using the sales comparison approach, right? You get an appraisal, you got the subject property that you're having appraised, and then you have comps, comparables, right? And the appraiser will make a price adjustments based on different amenities that each of the comps have. In my world of multifamily investing of 5 or more units, the main valuation method is the income capitalization approach, or the cap rate approach, okay? But we will use the comp or the sales comparison approach a little bit to compare maybe the value per door, the condition, different assets. But by and large, what you need to answer your question specifically, the net operating income, the NOI, is the driver of the value of the asset by and large. Why? It's perceived, and it's just a perception in my book, as a more subjective way of arriving at a subjective valuation, basically, because you take NOI, you divide it by the average cap rate for comparable properties in your marketplace, and you arrive at an approximation of the value for this asset in relationship to other comps in the marketplace. You understand what I said? I know it's getting complicated, and it takes me 3 days to teach this stuff, but by the time I'm done on the Sunday, everybody understand all these things. That's what it is. So the income, the NOI, is the driver of the valuation, Anthony. That's what the key difference is. So the greater your NOI, the property will appreciate exponentially. Want me to do a quick calculation for you?
Sure. Yeah.
All right. So let's do this completely spontaneous. But let's say I got a building, which is a realistic number, generates $100,000 in NOI a year. Okay, I divided by, all right, so $1,000 divided by, we're going to use, let's say I'm going to go with numbers out in your, let's say west of, Toronto, GTA, 4% cap rate. Okay, I get a value of $2.5 million. Okay. But let's say that was with $100,000 annual NOI. Okay. So let's assume the cap rate is constant, and I use 4%. I got to remember that, help me to remember that. But let's say all of a sudden I give a small increase to this property. Let's say I increase my NOI by $6,000. Okay. So all of a sudden my income now is $106,000. You agree with me? I had $100,000 before. I still divided by the same cap rate of 4%. Look at what's going to happen to the value. I just made $150K, Anthony. You follow me?
Yeah.
And just by increasing my rent by $3,000 a year, so exponentially. So it doesn't take long. After a number of years, you give your little rental increases that you can create wealth a lot faster. but you still have to service your mortgage after that. So that's sort of a key difference with smaller rental properties, is that the value of the asset is derived out of the income that the property generates. Now, how do you find out the 4% cap rate? Well, you look at the market and you find comps, same kind of construction type, condition, and so on, neighborhood. And you can calculate the cap rate for each of these properties that recently sold. And you say you arrive at an average. In this case, for a comparable property, I just used an example, 4%. That's how it's done. Yeah. Okay. So a key difference with small rental properties. But if you ask me why, and that was one of your questions here, why do I prefer multifamily, like larger apartment buildings? That's the reason, man. I can create more wealth a lot faster, and the property has enough income to pay for a professional property manager plus an on-site manager. So Pierre-Paul can go skiing, traveling to Italy like I did in September. I don't know where I'm going this year. Stuff like that. I have time, living life on my own terms, as you would say, Rockstar.
So do most of your students, do you find that they're graduating maybe from single family, or they start out single family investing and move to multi-unit? How many people really start from no real estate investing experience and go right to multi-unit?
Good question. So you've got two questions in there. Yes, I would say that the normal graduation for my students is they're like, I don't know, I haven't asked you if you invest in multifamily properties, or do you or do you not?
I own some student rentals, but
okay, but not multifamily.
No, they're single families chopped up into multiple bedrooms.
Okay, but you're right. The majority of people are people like in your shoes that have invested in smaller rental properties, and then they say, "Jesus Christ!" Whoops, I was about to say a bad word. This is a lot of work. These small rental properties, isn't it, Anthony?
It can be. It can be.
Yeah. So why don't I do multifamily properties, which have better economies of scale and better leverage? And that's how they come to the realization. So it's unusual for people not to have any kind of prior real estate experience, but it's not necessary, actually. Yeah. I think that if people knew before they started investing in real estate at all, of the benefits of investing in apartment buildings, which we can cover, because I think that was one of your questions there, I think they would jump sooner to investing in multifamily properties. But like Tom and Nick and the speakers that are at those events, at Rockstar events, any real estate investment you should try. But I want to restate that we have a housing emergency in this country. Get off your butt and start investing now, because you're going to regret it. We have now opportunity, and it's across Canada. Obviously, it's more dire in your neck of the woods and GTA, Lower Mainland, British Columbia, and larger cities. But it is a phenomenon across Canada. No difference here. Actually, here it's at the onset because how home prices are still low. But anybody can do this. You don't have to be a former CMHC underwriter like I am. Especially if you take my course, I share all my knowledge with you. Matter of fact, Anthony, just a couple of days ago, I reconnected with a blog post that I just posted yesterday for people. You can go to multifamilyinvestingcanada.com. A couple, they had, like you, invested in small rental properties, and then they were in the process of buying, or they had a 9-plex kind of more or less under contract, or somebody was holding it, but they realized we don't have the wherewithal, the knowledge to proceed with financing. Took my course within, I think, a few weeks, closed on that 9-plex. After that, they bought a 28-plex. So you're correct. This is the usual way. People have some experience first with smaller rental properties, then they move on to multifamily, but it's not necessary.
Now, Pierre-Paul, what are the barriers to entry to the multifamily market for a lot of people? Is it raising the amount of capital needed for these potentially higher down payments on larger multifamily properties? Is it the net worth requirement that you talked about, where you need to have, was it for conventional financing, you need a 25%?
CMHC-Insured, conventional, sometimes it's the same, but yeah, in that vicinity, somewhere between 25 and 50% of the loan amount of personal net worth to qualify, yes.
In personal net worth. Okay, so if I'm buying $1 million property, I need a $250,000 net worth.
You got it.
Okay, so are these the barriers to entry?
No. I tell you very frankly, it's mindset first, okay? As Henry Ford said, whether you think you can or you can't, either way you're right. And Henry Ford, that built Ford Motor Company, okay? So it's mindset first. We all tend, as human beings, we have all our limiting beliefs, so we tend to think small. And by the way, I'm number 9 of a family of 12 kids from some mining town in northwestern Quebec. So I grew up with plenty of limiting beliefs about money and and being rich and all of that. So that's your first hurdle. Then I would say it's education. This stuff, unlike smaller rental properties, and I don't want to put down people who invest in small rental properties, but my world is a highly specialized world. The stakeholders you're going to be dealing with, from the realtor, mortgage broker, building inspector, and of course the lenders, all expect you to have a higher degree of knowledge in this business as you start interacting with them. When you don't, this is when you get blacklisted. And believe you me, I can tell stories until I'm blue in the face of actual real people who try that. So I think so. Just to recap, mindset is your first hurdle. Changing that mindset, and it's a mental gymnastic, just like working out in the gym. You can change that. Then it's knowledge. You got to get some knowledge if you don't want to burn bridges. And after that, it is capital. But you've heard it from me, my former job, managing defaults. I was bored out of my mind. I told you that during the recession, they didn't default. Apartment buildings didn't default. I'm telling you, if we have a recession this year, soft landing, whatever, they don't default. I mean, rarely, unless you really screwed up the underwriting, the analysis of the investment at the onset. But if you use systems like the ones that I teach, CMHC has the highest standards in the land in terms of assessing these deals. So
why is it that you see this history of them not defaulting? Is it because of the cash flow from the multiple units just helps cover you?
It's low risk vacancy. Like I said, the rent check is the last check that's going to bounce. During COVID, when COVID began in March 2020, at the beginning, we were wondering how we're going to be able to rent our vacant units. Well, people continued to pay at 96% average, national average in Canada, their rent. People did not default on their rent payments. So for that reason, people always need somewhere to live. And I think it's also the underwriting parameters that I'm more than happy to teach. That's the workshop that you see behind me. If you follow those steps, there's no such a thing as 100% risk-free investment, but it's pretty close up there. And especially if you go CMHC, but even on the conventional side, it's an asset class that is very stable, very counter-cyclical. When the going gets tough, it does well. So it's a low-risk asset.
Pierre-Paul, what are you most excited about recently in the world of multifamily? What's the most exciting change that's come? Is it the CMHC MLI program?
I'm definitely stoked about that, Anthony, because like I said, I started my first application. I'm refinancing this apartment building. It's my largest. It's a 38-unit building. That's very exciting. Absolutely. It gives you a lot of flexibility. Going up to 95% loan to value, I don't think is advisable in my book. And a DCR 1.1, that means that your NOI barely covers your mortgage payments. And to be honest with you, I'll give a hint to people. When I teach this stuff during the upcoming 3-day workshop, I give one set of numbers when you play the financing game. Then I teach my students the real numbers. And for some odd reason, in that world of appraisers and bankers, they don't have all the numbers, okay? So when you calculate a DCR 1.1 based on the game that the banks and CMHC and conventional lenders play, it's too tight. So I would not recommend, even though CMHC offers you a very low debt coverage ratio 1.1, I don't recommend that. That you're putting on many layers of risk over that deal, which I would not recommend. And that's the kind of a talk when I speak as an underwriter or as an investor. I would draw the difference, different games being played. But there are games being played in this industry. You probably know that even in the small rental world that you operate in. So, but that's exciting. What I'm excited about, I keep coming back to that housing emergency. It's a great time for opportunities. I chose to be a landlord, and I'm not a slumlord. My units. I'm in a beautiful home with renovated basement here. I've got the laminate flooring and all of that because I know Canada. That's what excites me. Canada is moving towards becoming a society of renters, just like the majority of the world are. Like in Europe and most countries, people rent. They don't own homes. And I'm on the right side. I'm on the landlord side. I'm going to benefit from that. And it's not like taking advantage of a bad situation. I didn't create that situation, but I'm certainly going to take advantage of it by being a good landlord with sound. So that really excites me. I'm glad to be in the right place in the right kind of business as a real estate investor.
Mm-hmm. Okay, these multifamily deals, you keep saying that it's more business-like, and it definitely is because even the properties are valued based on their income and not comparable sales. But do you have to submit essentially a business proposal or a full business plan when you're trying to qualify for these properties?
Okay. So let me toot my own horn. When you take my course, you actually get my sample financing.
I feel like I'm setting you up here, and I don't mean to. I just really am. I'm curious, and it feels like every question I have, the answer is take this course.
Well, it's because I used to be a lawyer too, right? Remember? So when I used to go to court, you stand in front of the judge and you got all these stats. So this is the property risk factors. You got everything pertaining to property condition, etc. Then you got the market risk. So everything pertaining to what are the risks in the marketplace, rents, how are they compared to average? And then you got the third risk factor, the valuation risk factor. Okay. Mm-hmm. And then of course you got the borrower risk factor. You as a borrower, your risk factor. So the point is, this is what you have to submit to get financing.
So Pierre-Paul, for the people listening, Pierre-Paul's holding up a thick binder full of papers with dividers, and he's flipping through it. And so that's an example binder of a property proposal that you submitted?
Correct. And wow. So it's called the financing application. And when you take my course, you get a template, my template, the real application. All I have to do is put in your information the way I formatted it. And you're going to look like, and no pun intended, like a freaking rock star. And I mean this because I heard it again from this couple that took my course and are building a 296 unit building out east on the East Coast. The lender, BMO, was blown away by their knowledge after taking my workshop. It is kind of a management plan. I like the term that you used. I would submit a management plan, for example, Anthony, if it's one of those maybe a class, I'm going to say class D property that needs some TLC, some upgrades and all of that. In that particular case, let me give you, and this is how I teach, right? I teach experientially. We analyze deals in my class. Not all I like Pierre-Paul flapping his jaws. And I have guest speakers, including a mortgage broker. But let's say I buy a Class D building. It needs a lot of work. So my NOI is not maximized because I need to maybe evict some tenants. I need to complete some upgrades. I need time for that. Then instead of committing this deal to a full 5-year loan term, which is a standard loan term, you can get longer terms if you will, but let's use a standard 5-year loan term. Then I say, okay, I need a bridge loan because that's another question that you were asking me, right? I need a bridge loan because I need to do some stuff to this property to maximize, to stabilize it, in order to achieve the maximum NOI, therefore the maximum valuation for that asset. So I'm going to take a bridge loan, an interim loan, or a mezzanine loan, right? It's going to take me to a larger loan amount in the meantime, and it's usually 12 months. So bridge loan is usually a bridge loan is about 12 months, and upfront the lender wants to know, how am I going to get paid out at the end of the 12 months? Hence, the management plan that you were referring to, that's a circumstance where I would say, here's what I'm going to do, complete all these upgrades, do this and that with the property, increase my rents to X amount because the market can support these rents and so on. So that's why it makes sense to get a bridge loan until I can maximize or stabilize my asset and maximize its performance. Then once I'm done with my bridge loan, I've done all these things to my asset. And by the way, that's what I'm teaching tonight in a few hours of financing and a case study on point. Once I've done all these things, then I have two choices. And a picture is worth 1,000 words. Then I have a bunch of choices depending on circumstances I'm facing. In this case, after my bridge loan, I can go what? Tony, question for you. I'm going to check your knowledge now, verify your knowledge. What are the two ways I can finance my deal after my bridge loan?
Conventional financing or CMHC-Insured.
You get an A, my friend, you get an A. But again, there's various circumstances depending on what I'm dealing with. Okay, so just to give you an example, a picture is always worth 1,000 words, right? You don't teach an old monkey like me how to make faces. You know, I've been there, done that. So, but yeah, so that's kind of it. That's how you would decide which type of financing to use based on the circumstances of your deal, based on whether you need the CMHC flexibilities or not. One key flexibility about CMHC, I forgot to mention that. That's super critical. Your interest rate, when the bank has their loan insured by CMHC, the interest rate, Anthony, is 1% lower. Imagine what it does to your cash-on-cash return on investment. Significant. Okay, you make more money by going through CMHC. But I'm not going to dispute it. I used to be a freaking bureaucrat in the cubicle at CMHC. It's a pain in the butt to deal with my former employer. It's a pain in the butt to to prepare one of these financing applications. But one of the things that very few people, even though I teach people how to do this financing application together, very few people have the guts and the perseverance to do it. They usually resort to working with a mortgage broker, which is not a bad thing. But my job as an instructor, as a teacher, is to empower people like you. If you choose to, you can go directly to a lender, which is usually what I do here. Okay. In this particular case with CMHC MLI Select, because it's brand new, and by the way, because I'm getting my mortgage agent license, I'm going to work with a friend of mine who comes to my workshop. He's a mortgage broker. But what I want people to understand is I'm putting them in the seat. They have the power to go straight to a lender, which is always what I've done, thereby saving me 1% of the loan amount in mortgage broker fee.
That's if you get it CMHC insured. But then aren't you paying?
Any mortgage broker will charge you roughly 1% of the loan amount in broker fee.
Oh, got it. Sorry.
Regardless whether you CMHC or conventional. No.
Oh, sorry. I thought for some reason I had heard that if you go CMHC insured, then you save the 1%. But you're saying if you go straight to the lender, not a mortgage.
You're confusing two things. So you're right, actually. You're right. It's confusing. I get it. Because both are 1%. No. Mortgage broker, usually on average, negotiable, you can shop around, will charge you 1% of the loan amount in fee to prepare one of these financing applications. However, when you go conventional financing, the interest rate is 1% higher than if you go CMHC insured financing. Okay. So it pays off to go CMHC, but it's a pain in the butt significantly. A lot of hoops. They're very demanding. But anybody.
Okay. So let me ask you this. Aren't you paying a premium if you go with the CMHC insured? Because you're very good
interviewer, Anthony. Very good question. Here's the thing. You recover that within 5 years because you pay an interest rate lower by 1% when you go CMHC insured route. You get what? Your loan payments are lower. Therefore, you get a greater cash flow. And that money, the insurance premium, you don't have to pay it. It's the bank. What the bank will do, it's not extra cash that you got to come up on top of the capital. The bank will capitalize the insurance premium on top of the loan. It's going to be amortized within the loan amount. So very good question. Thank you for reminding me of answering that question. So I want to repeat. Yeah. Yes, you pay a mortgage default premium, like any insurance, you pay a premium, but it's not extra money you got to come up with. Let's say you get $1 million loan and your premium is, let's say, $50,000. The bank will increase the loan amount by $50,000 and amortize that loan of $1,050,000. So it's not extra money. And you recover that within 5 years because you get a greater cash flow.
Yeah, it just reminds me when I purchased my first rental property, I put 5% down and it was, just a single family home. And everyone was like, hey, but you're paying a premium for the mortgage insurance. Like, why not wait till you save up 20%? And I was like, look, do you think I come from money here? Like, do you know how long it's going to take me to save up the 20% at the time? And I was like, big picture thinking, I'd rather pay this mortgage insurance premium because it gets me in the market. And I think it was like $16,000 or something. And it was amortized over my 25-year mortgage. And then that was back in 2019. The home has gone up by at least $150,000 in appreciation and, all kinds of other benefits with the cash flow.
Well, you've been taught well, right? You've been taught well. And let me guess, you got black hair, but no gray hair yet. So how long ago was that? What was the interest rate on that first purchase of yours?
So that would be 3 years ago now in I guess going on, 3 to 4 years ago, sorry. And
the interest rate was next to nothing. What was the interest rate?
2.69. 2.69.
Ridiculous. It's free money.
It was free money. Yeah.
And because you've been, you're a part of the Rockstar family. Like I said, I look up immensely, to the Rockstar family and Tom and Nick. I mean, you've been taught well. Yeah. People think small. People think too small. You've got to think business. You're earning the money. Well done for a young man. Yeah, absolutely. Yeah.
Okay. Thank you. So I had another question, the mortgage broker. So mortgage broker can be a great option for single family rentals because they have options to go with all these different lending products and relationships with different lenders and really get you the best deal that can, it might not even be the lowest interest deal that's out there, but it could be the deal that allows you to keep qualifying for more and more mortgages, if you're looking to really grow your portfolio. Yeah. So is there that type of, kind of big picture benefit to working with a commercial mortgage broker? Absolutely. For the majority of people, I would say yes. For a guy like me, no, who's plugged in with a bunch of lenders and, I don't need to. I shouldn't drink coffee when I'm doing an interview. It's the afternoon here.
Absolutely, Anthony. It does make sense to go with a mortgage broker, especially if your deal is funky and you don't have the level of sophistication, and also just to shop around for the best lender for the circumstances of your deal. So I think it does pay off to go with a mortgage broker. There was a time, I admit, and this friend of mine that comes to my workshop, and hopefully I'll end up working with him, because I just want to backtrack a little bit. I am getting my mortgage agent as soon as my workshop is done on Monday. I'll knock it out within a few days and get my license. I hope to work with that person. But in the old days, like I said, I went straight to lenders because I used to know these lenders when I was at CMHC. So I already have this fantastic relationship with the lenders. But the one thing that I don't have is all these connections with different kind of lenders that the mortgage broker has access to. And like I said, Anthony, without getting into details, I started to give you an example earlier. When you have a funky deal that doesn't quite fit the mold, especially for CMHC, the mortgage broker knows a bunch of different lenders that have different risk appetite, and they will match you with the right lender for the circumstances of your deal. So I do encourage people to use a mortgage broker, especially at the beginning. This being said, not to toot my own horn, but here we are. Like I had my heart. No, but it just happened 2 days ago, right?
Yeah, that was. I just have to say that was the best segue ever. But here we are.
Like I said, I live in Calgary, my friend. It's not my first rodeo. You know, if you heard about the Stampede.
Pierre-Paul, you're a lot of fun to talk to, man.
Well, that's what Tom and Nick say. But usually we drink when we do these podcasts, Nick. I mean, Anthony, next time you and I have to have a drink.
Let's do it.
But
let's do it.
Seriously, though. This couple, it's like I don't follow up with my students. They did this interview with me, just like you and I are on Zoom 2 days ago. In the background, do you know what I see? I see the ocean. They're in Ecuador in their brand new freaking condo, man. All right. And they told me, they said, we did what you said. We went straight to the lender. Now this lender wants to finance our construction of 296 units. Okay. Wow. And I gave them the lowdown. Now that's a much higher level of sophistication. So I gave them the general picture how to handle this. But the point is, you can save a lot of money. If you do that, you have the power to do that. But in their case, they already have a very close relationship, like I do with one particular lender who has appreciated their level of sophistication. That makes sense. But if you don't have that, then a mortgage broker definitely makes sense. I cannot deny that.
Okay. How does the lending landscape kind of look for multifamily in terms of, is it banks lending you money? Is it credit unions? How does it compare maybe to single family?
I like it. I like it. The one thing that you need to remember, and this is kind of, I teach this in this phase here, right? So sort of the planning and research. The multifamily world is a very specialized world. So whomever you work with has to be a specialist of multifamily. We're talking from the realtor's point of view. You need to work with only multifamily realtors, building inspector, mortgage broker, and lenders. Credit unions, some of them, if you're lucky, but I don't have a fond memory of working with credit unions. Why? Because they do so few deals like that. The stuff that I teach, they don't have that knowledge. I'm generalizing, okay? There's always exceptions to everything I'm saying, and my big caveat up front. But that has been my experience but any lender, any chartered bank can do it. They need to be approved. If they go CMHC, they need to be approved. But generally speaking, you want to make sure, ascertain that the lender you're dealing with or whoever you're dealing with, the other stakeholders, realtor, et cetera, are multifamily specialists. In terms of the landscape, like I said, these are to be a multifamily owner. We have this housing emergency. So you know that people are looking for rental accommodations. They will be for decades before this problem gets solved. And so all across Canada, obviously, GTA, it's a bit of a stampede situation. You know, I considered, and I did my homework in the Golden Horseshoe, for example, all the way from, if you will, Oakville, going around the lake, all the way to Niagara. I looked at properties and so on. You got values that are extremely high, cap rates, therefore very compressed. So that's, it's a difficult environment there, right? But there are other markets.
What makes it difficult? Is it just the reduced cash flow?
Because you're paying high prices per door, right? The demand for these housing accommodations is so significant, and there's a lot of investors competing for these few properties. But rents are at the 20-year high right now, and vacancies are going down because they bring in 500,000 immigrants every year. 1 million people entered Canada in 2022. These numbers are staggering. And that's why I say that this housing emergency is going to become a social issue. The reason, sorry, I'm not a clown, but you gotta be entertaining. We're teaching. People will remember when I get close to the camera. It's going to become a social issue. It needs to be resolved. So the landscape looks really good for any landlord in Canada, in my book.
Okay. So are the banks that are lending, is it the big five banks?
Yeah, it's usually the big five banks, but there's some lenders that are specialized. One is First National, is the largest, actually, one of the largest lenders in Canada. You got people like People's Trust. But like I said, you'll get your BMO guy that will do it. Just make sure that they have multifamily experience. The reason I insist on that, Anthony, is because so many times, and now when I was an underwriter, right, and you got some credit unions submitting a financing application, hasn't done a multifamily deal ever, and you, as the investor, you think you're freaking out because they don't know how to do it and it's taking a long time. They're submitting incomplete financing applications to me, and then it delays, and maybe you're going to lose the deal, maybe you're going to lose your deposit. Do you imagine your level of stress? So you don't want to do that. You want to work with the pros in this particular world, but any chartered bank can obviously make a multifamily loan. That's not an issue. But just make sure when you interview your banker, how much experience do you have in multifamily deals, and how many have you done in the last year or so, to give you an idea. That's what I teach my students, how to select who they're working with.
Okay, so it sounds like you teach your students a well-rounded array of skills and strategies. What do most of them end up doing? Do they go with value-add projects? Do they go with turnkey? Like, what do they actually go out and do in reality after taking your courses?
I don't know. Why? Because I don't follow up with them. That's why I got so excited the last couple of weeks when this young couple that took my workshop just in November 2020 got back. Yeah, I don't do the following up, but it's all of the above. So obviously a value add is what we all look for. For example, tonight, if people have, because I know a lot of rockstar have signed up for the masterclass tonight, that's why I'm doing an extra one. Because the last one was supposed to be last week. In my example, it is an example of a value add, because for us, it's a gem in the rough, right? My NOI was below, particularly this case study that I'm using tonight in my masterclass. Like, it's going to start in 3 hours. I show exactly how a bridge loan works, because my rents were below market average quite significantly. I think my rent increases were like somewhere between $100 and $150 a month below market average for that zone. Okay. So I knew that I needed to get a bridge loan to deal with that specific situation. And then I knew at the outcome, once I had completed the repairs and increased my rents, I would apply for CMHC-Insured loan. Why? It's a pain in the butt, but I pay an interest rate 1% lower than if I go conventional financing. And so that's how, but a value add enabled me, get this, we got a cash on cash return on investment in 10 months, because I don't use my own money. By the way, like I said, when you ask me what are the obstacles to investing in multifamily properties, first one is what? Mindset. And then is knowledge, understanding how the mechanics of this game, they work. But then we went with, we did cash on cash return on investment, 37% in 10 months. So I gave my shareholders 30% of their capital back within 10 months. Now, in Alberta, unlike Ontario, and I used to be an on-site manager when I was at U of Ottawa. I used to be the on-site manager, and I did legal aid when I was in law school in Ottawa. But we don't have restrictive rent controls here. The only restriction is you can increase your rent once a year at the most, but the amount of your rental increase is not capped. It's whatever the market can bear. And we still have the lowest rents pretty much in the country, and lowest home prices as well. So they do whatever. This is the thing, Anthony. And this is why I have charts like this, especially on the financing side. Depending what the issue is, you want to pick the type of financing that will get you to where you want to go. And one thing, it also depends what you want. This first box, planning and research, is about you, the investor. What do you want? What do your shareholders want? What's your tolerance for risk? What's your budget? What level of effort? When I started, my hair wasn't this gray, and I had way more thicker, right? But my kids were this big, right? I didn't want to take on a value add kind of project, or maybe a class B plus, a few things to do. So you will adjust. And then, so this is the first box of the entire investment process. And guess what it ends? Can you read this? This is also your goals, risk tolerance. It goes straight back to what you want at the onset. And you will use the strategy, whether it's financing or investing strategy, that will match the circumstances of your deal, of your market conditions, of your desires as an investor, is in a nutshell. Yeah.
Were you a real estate investor in, let's say, single family when you were working at CMHC, and then you started underwriting these deals? Like, what attracted you to get into multifamily, and when did you get into it?
Well, I married into real estate. My wife was like you. She had single homes. And the moment we started dating, guess who was up on the roof, fixing the roof, painting and renovating? It was Pierre-Paul. My wife is very much involved in our real estate. She's got tremendous business savvy and real estate savvy. But no, look, I just lucked out. I mean, again, my gratitude rock. I'm very grateful, very grateful. I was working for CMHC International, but I didn't know the core expertise of CMHC. So I wanted to work on international projects, but accordingly, I needed to develop or acquire that technical mortgage default insurance. So I moved to Calgary, I acquired it, and then all of a sudden, you're exposed to all of it all at once like that, right? I did single underwriting, like I said, the stuff that, you do, smaller rental properties. Then I did default management in real estate. Then I did multifamily underwriting. So all of a sudden, I was exposed to everything, the entire picture, and quickly understood. Like 2008, Anthony, remember, 2008 was the big credit crunch. We all remember. This was scary as hell, okay? The banks in between themselves were not lending money overnight, lending to each other. That was scary, I'm telling you. And I had my first building on my own. I had bought one as a silent investor before that, but at some point, the money wasn't there almost, and my lender didn't say, Pierre-Paul, yeah, I know I approved your loan, but I'm not sure if I'm going to have money. And then 2009, officially, the Great Recession began. And Anthony, I want your people watching this. When I get close to the camera, it's important. My big aha moment came in 2009 when I saw, as a multifamily underwriter, sitting in my little cubicle at CMHC, how much multifamily owners were making. What happened back then? Interest rates dropped down significantly. That's when they came down to about 2% range in 2009. And multifamily owners were refinancing their multifamily products, pulling millions, especially the large landlords, the real estate investment trusts, and with that, buying more apartment buildings or investing in other ventures. So for me, that wealth multiplier effect, the big NOI multiplier effect, I saw it. I said, holy shit, I want to invest in multifamily properties when I grow up. And the rest is history. Yeah, that's why I did it. That's what appealed to me. And quite frankly, there's no end to that, right? Right now, I have some people with the MLI Select. They're saying, why should I ever bother paying my mortgage down? Because if I find it's up to 95%, I get this huge cash flow. I can keep doing this forever. Mm-hmm. As long as you maintain the property. And that's, again, I don't want to get into the nuances. That's also something I teach. So I want to appreciate it. And again, not trying to teach, but you got to look at it from the offensive point of view. Yeah, it's all nice when you buy a multifamily, but always keep in mind on the defensive side what can happen to market conditions, which we all know. And I know the story of Tom and Nick's family back in the 80s, right? We've been in the studio recording, and Tom was sharing that with me and Nick. So you always want to make sure that you mitigate that risk, right? And what I teach people is to get into my former self as an underwriter. What are these risks? How do you mitigate them so that you have a successful investment? And don't be too greedy. Like I said, the only caveat I have about CMHC MLI Select is some of these flexibilities, like low DCR 1.1 is so freaking low, and financing up to 95%, not because the government tells you can do it, that you should be doing it. I don't think you should be doing it. Maybe scale that back. But still, though, if you go up to, let's say, 80%, all you have to put down is 10%, Anthony. So I think that could be worthwhile considering, depending again on what you want to do as an investor. Because in my early days teaching this, I'm not in your shoes. If you like me, you're going to use OPM, other people's money, which is what I do. Most of my students do, by the way. Capital is not your issue, you guys. It's your mindset first. You can think differently and get rid of your money limiting beliefs. But you've got to make sure your shareholders and you are on the same wavelength in terms of investment goals and investment horizon when they want a return on investment. So that's why. But if you go at 95% loan to value, it's a higher risk loan. So will market conditions always support higher risk like that? you never know. And I don't think you should count on that to be always rosy. But right now, the landscape for becoming a landlord, whichever form, not just multifamily, but obviously multifamily, you have the wealth, the multiplier effect of cap rates. It's best because, it's more bang for your buck, for less effort. We all want a life and go skiing like I do and traveling. That's what we're in it for, right? So multifamily allows you to do that more. There's less sweat equity involved, a lot less.
Is commercial and multifamily kind of interchangeable terms?
Good question. I'm glad I addressed that up front. Usually it's confusing. So when people say, oh yeah, I got commercial private, okay, like what? Commercial residential? Because what I'm teaching is commercial residential. Again, the income, the driver of the valuation is the net operating income, okay? Or is it retail, commercial retail, like a hairdresser salon or a dry cleaner or whatever restaurant, okay? However, when we refer to commercial, we mean essentially what I just said. The income, the net operating income is the driver of the value asset. That's what we mean by commercial. But there's a distinction. Is it retail or is it commercial purely, or is it commercial residential, which apartment buildings are? So that's, to summarize it in a nutshell, that's the difference. You got to specify that. For example, let me give you an example. I'm in oil country here, and I hang out with filthy rich oil and gas people, and they buy oil-related assets, and it's the NOI is where it's at. They're also income-producing assets, and the NOI is the driver of the valuation for these oil and gas assets. Just like apartment buildings, just like industrial, it's the NOI is the name of the game, and it's your best friend. Okay.
What are you seeing in the Alberta market right now, Pierre-Paul?
Good things. Thank God. It's been a rough ride. I'm not going to swear, but I'm tempted to. It's been a hell of a ride. Okay. You can fill in the blank. Yeah, it's a unique market in Alberta. Let me be very blunt, and I don't know how to be different, and I teach that way. I share my mistakes as well. I haven't made any mistakes. To be honest with you, CMHC made mistakes. My banker made mistakes, but it's a unique market. You just got to be careful. We have great things happening in Alberta. Hopefully we can get rid of Justin once for all. It's going to be even better. I had to put that one in there. You know that.
By all means.
So, rents are going up. We've not given rental increases. Listen to this. In 6 years, I just February 1st gave my first rental increases in 6 years. So it's been a hell of a rough patch. Why? It's a unique market. And I think previous governments in Alberta have failed in diversifying the economy. And so when the price of oil went down starting 2015, 2016, and then of course with the strategies that the federal government, Justin Trudeau, namely, had towards the oil and gas industry, oil and gas companies started to divest from Alberta, and we had out migration instead of having in migration and all that. So all the fundamentals that we look at in the real estate market started to I guess to deteriorate is the best word that I can say. So it's been a rough ride, but now all the fundamentals are extremely strong. We have a population growth. In the next 20 years, the population of Canada is going to go from about 38 million to 45.6 million, okay, between now and 2040. 16% of those people are coming here to Alberta. We're finally diversifying. We just saw the budget yesterday.
Did you say 16 or 60? 116.
16% of those
16,
are supposed to come here. Why? Home prices are lower, rents are lower, and job opportunities, the highest wages in the country, are coming here. So all the fundamentals are becoming very strong. Federal budget yesterday allocated a lot of money. I'm still taking it apart. Have allocated a lot of money towards green transition measures. And so we got Edmonton's been now dubbed the hydrogen capital of Canada. I was looking at something else because I do have a bit of a newsletter for my investors, investing in recycling material as well. Like, it's so dynamic in this province, and never underestimate the pioneer spirit of Albertans, because Albertans, the majority of them are not Albertans. They came from Nova Scotia, from Vancouver, from Ontario, looking for better life. And I'm one of those that came here in 2002. And that pioneer Albertan, innovative spirit is so strong. It's a beauty to see. So very optimistic about Alberta. And I'm not the only one. A lot of people from your area, from GTA, are coming out here. So I'm very, very hopeful and thankful and grateful.
So are you seeing prices and rent increase in the last bit?
Yeah. Oh, yeah. Yeah, they are. Yeah, they all across. It depends. Every building's different depending where it's located, the area. But some increases depending whether the units are renovated or not. But they're in the range of, and people are going to be salivating over the number I'm about to share with you. But some of them can be 19%, 12%. Because again, in Alberta, there's no cap on how much you can increase your rents. Is whatever the market can bear. So my philosophy during those difficult years, a lot of shareholders were not happy with me necessarily because I was upgrading these units because I knew, I wasn't looking at the rear mirror. I was looking at what's coming, which is where we are now. People wanting very good rental units. And I put in the money. Now it's crazy. 1-bedroom unit, if you wanted to the kind of upgrades, which are higher upgrades that I have in my own house with the beautiful wide baseboards and vinyl planks, it's like $15,000 for a 1-bedroom unit now, right? With inflation costs. But then imagine the rents I can charge for that. That's how I can get these high rents. So that's the situation we're experiencing here. Mm-hmm. More competition at the same time, mind you, but hey, it's business, right? That's what business is all about. It's competition.
And are the main markets Calgary and Edmonton? Are those the main two drivers?
Yeah. But there's Red Deer as well. There's other markets as well. That's something I'm glad you're asking the question. I would not discard other smaller markets, whether it's in Ontario. Like I come from Rouyn-Noranda, which is from Kirkland Lake. It's an hour east, and I'm very familiar. My dad used to be a logging contractor in Northern Ontario. I know a guy, I won't name him, but he's in Kirkland Lake buying multifamily properties, done extremely well. Why? Because you get to buy these assets at a higher cap rate, meaning a lower price. So cap rates and prices move in the opposite direction. Low cap rate means a very high price. High cap rate means a low price. Okay, so it moves the opposite direction. Doing extremely well in Kirkland Lake because you can get your hands on multifamily properties a lot cheaper than you can in Toronto or Calgary or Edmonton. So don't discard smaller remote markets necessarily. You just got to do your homework. Mm-hmm. Yeah, and assess the risks properly and mitigate them accordingly.
Okay. Pierre-Paul, we've covered a ton of stuff here on multifamily. You've been talking about this course this whole time. It's coming up this weekend. Do you want to let us know about it?
So I'm going to do something. I'm going to, there was an early discount. This all happened, I was reached out by you, Tom and Nick, to do this podcast at the 11th hour. But I'm going to open up the early bird discount until midnight tomorrow, which is Thursday, the March 30th. Yeah, we're the 29th. Gives you $200 discount. The course is $22.97. Now, I'm going to be very blunt. If you think it's too much money, you're in the wrong place. My job, what I can do is put you in the stratosphere as a multifamily investor. Just look at my last blog post broadcasted yesterday. These folks now are the favored investors of that lender just because they took my workshop and had that higher level of sophistication. And I teach you from beginning to end how to start from scratch, how to think, how to plan your move. I show you multifamily hacks, all the hacks I learned at CMHC as an underwriter, as a full-time investor, to shave years from your learning curve and make you look like a pro and get the best financing terms and conditions. But what I want people to understand is all experiential. We take one of my buildings as a main case study from beginning to end. We go through the entire analysis, how I assess the 4 key risk factors: property, market valuation, and borrower, and how I financed it and why. With concrete example, due diligence documents, review all of that. It's hands-on. Then on Sunday, I have a few guest speakers. You get the on-demand course as well for the same price, that $22.97 plus GST. Anthony, you get lifetime access to the on-demand course and all the upgrades. And I'm currently using all this nice fancy technology that I have now with 2 4K cameras and all that jazz to record the entire course. And you get 1 ticket to the live workshop, which is Friday, March 31st. At 9 a.m. It's a lot of work. If you're a tire kicker, you think you're going to sit back, do nothing, you got the wrong guy here. You got the wrong instructor and the wrong business. And if, again, you think that spending $2,200, $2,300 on the course is too much, your mindset is not in the right place. If you want to buy a multi-million-dollar asset, this is nothing. And my course is way underpriced. Everybody keeps telling me that, but it's a labor of love. So if you want, I'll give them, so they can send me an email at support@Multifamily Investing Canada, support@MIC, Multifamily Investing Canada, and tell me you're a Rockstar member and I'll give you that discount. But please act fast because I hate to tell you, technically you do have a bit of homework to do before you show up on Friday. But if you haven't done it, it's not the end of the world. And the course will be recorded. You'll get the replays for up to 3 weeks after the workshop. I don't recommend you miss. This is, I'll be blunt, Anthony, it's for people really committed. This is not a tire kicker kind of business by any means. The rewards are commensurate with the level of effort. But if you're a tire kicker, don't bother.
Okay.
That's what I'm saying.
Today's Wednesday, March 29th. I think we're going to release this podcast tomorrow, Thursday, March 30th. And then the course is that weekend. And if people can't make this course by the time they hear the podcast, what are their options, Pierre-Paul?
They get the on-demand course as well. They can buy the on-demand course. It's always there available for sale at Multifamily Investing Canada, MIC, Multifamily Investing Canada.
Okay, so the whole course is recorded and they can watch.
Yeah. It's a small module, so bite-sized videos. It's the same content, except you get way more value. I'm not going to deny that, right, Anthony? You get way more value when you come to the live workshop. Like I share a lot of stories. You can tell I'm a storyteller, right? Yeah. And I have my stories and I have those of all the files that I've underwritten on my students. And we bring a mortgage broker and a building inspector. Ideally, the on-demand course contains a video of a full building inspection. And during the live workshop, the building inspector comes and answers all your questions. And I have two guest speakers, a mortgage broker and a successful student to share with you, with the students how they've made it. Now I have a student that's coming on Sunday, owns 280 units. And he was a Mennonite from rural Manitoba, grew up without phone, TV, any of the modern amenities. Now he owns 280 units, more than I own.
Wow.
So there you go. Anybody can do this.
Okay. I've got one last question. I promised my buddy I would ask you because I told him we were having you on. He's another young investor like me. He wanted to know, has the multi-unit investing market become out of reach for investors today versus when you first began? And I feel like I already know what your answer is going to be, but what do you think when you hear that question?
Well, I don't know if you have kids, but I have 3. My oldest is 25, is actually downtown Toronto now, working for a carbon trading company. I have a 23-year-old daughter who lives in one of my buildings in Edmonton and an 18-year-old who just joined the military. Wow, harsh learning. But my wife and I taught our kids never to take no for an answer. My big sister always says, when there's a problem, there's always a solution. If you cannot find a solution, that means you're part of the problem. So taking no for an answer is not part of my book. There's always a way. And again, it's mindset. That you've asked me that question at the beginning. What is the biggest hurdle? It's mindset. Yes, it's more competitive. The secret is out. And I'm partly at fault because until I came onto the scene in 2008, and it was through a group called RAIN that you may or may not know, I was crossing the country speaking. I kind of started spilling the beans about multifamily. Nobody was teaching it really. But if this is what you want to do, I'm the last person that's going to try to stop you. But it is work. This does not get rich overnight. This does not get rich overnight. I will not tell you that. But if Pierre-Paul can do it, anybody can do it. You don't have to be a former multifamily underwriter at CMHC. So
yeah.
I hope I answered your buddy's question. Did I?
You did. It's inspiring and it's realistic. And I think that's the best way you can handle life, inspire yourself, but be realistic about things. And yeah.
Roll up your sleeves, right?
Roll up your sleeves. You're going to have to work hard. Yeah, totally.
Yeah.
Pierre-Paul, it's been a pleasure. You're a ton of fun to speak to, man. We will definitely have to have a drink if we do this again. And I would definitely like to do it again. That. So,
all right. Thank you so much for having me and Tom and Nick. And I hope that people who are part of the Rockstar family appreciate how lucky they are to have you guys and have Tom and Nick, and with the immense value. I get a lot of value from a distance from Rockstar. So I'm very grateful once again. My little gratitude rock from the shores of Lake Titicaca in Peru. Thank you so much, Anthony and Rockstar, for having me today.
Thank you so much. And we're just as grateful to meet guys like you and have you on the show. So thank you for sharing everything.
Cheers.
Yeah. Awesome. Okay. Take care, Pierre-Paul.
You too.
Okay.
Hey, thanks for tuning in. You can find every new episode of the Your Life, Your Term show on all the major streaming platforms. So Spotify, iTunes, Google Play. And if you'd like to get free copies of some of the books that we've put together, like these right here, or some of the reports that we've put together, like these right here, you can find all of those at www.rockstarinnercircle.com. That's www.rockstarinnercircle.com. That's it for now. Until next time, your life, your terms.